So continuing with the second part of this chapter, the statement of cash flows, essentially what we're trying to look at here is just a summary of the statement of cash flows. And I'll go over my personal experience going over the statement of cash flows. I think is very important. And the intention is to basically reconcile all cash movements from last year's ending cash to this year's ending cash. And what do I mean by that? It means that you're basically starting with what was ending cash last year and saying what did all the transactions this year, what category were they in, and how did we get to the ending cash number? And basically we're saying how much cash is this business essentially generating or spending. Why do they have it? Because accrual accounting can be very confusing sometimes, and sometimes people really need to see, hey, how much is this company cash flow positive or is it cash flow negative? And do they need to basically find external financing as they're not really able to finance themselves from ongoing operations? So the three categories that items go in the cash flow statement is the operating activities, investing activities, and financing activities. And we'll look a little bit more into that. The operating activities is basically cash received from revenues, cash paid for expenses. So it's essentially items that are being used in everyday business. Investing activities is basically the sale of operational assets, sale of investments, collection of loans. So it's kind of like talking about, when you're selling, say you're selling like your computer because you're going to buy a new one. So for your personal, that would be investing activities. It's not like part of your day to day, but it's really regarding your operational assets, the sales and purchases. Financing activities are relating to basically issuing stock, issuing bonds, payment of dividends, repurchase of stock, and repayment of debt. So the distinction between investing and financing is that financing always has to do with either raising equity or raising debt or creating, borrowing or paying off equity or paying off debt. So think about it as like dealing with financing people, banks. Investing activities is really dealing with purchasing operational assets, like purchasing like a deer, purchasing a tractor or tractors, or selling tractors, basically. Dealing in capital assets, or loaning money to others and expecting it back, things like that. Items not affecting cash like depreciation and amortization. So these basically get added back in. We'll look into this and how this looks at the mechanics itself. But as you see, some items don't actually affect cash, but they affect accounting. So there's a little reconciliation that one does when you look at a cash flow statement, and we'll go over it a little bit. But essentially, the direct presentation I think is more common, is basically what we look at is cash received from operating activities, and then we look at cash flow from investing activities, and then financing, and then we could see the net cash increase in the period, beginning cash balance, and we arrive at ending cash balance. That's really it. How do we arrive at this number, cash flows from operating activities? There's another method to do it, which is basically reconcile net income to net cash flow from operating activities, and you do that by deducting items or adding items not affecting cash. This is also a method can be used sometimes. And this basically go through anything that didn't affect cash, whether it's depreciation or increase in liabilities or gains on sale of land. So these things basically amount to your net cash flow from operating activities. We just want to look at a summary of this at the moment, and basically This is a little bit of a more popular method, I believe, with the indirect presentation, the indirect method. And this is where you essentially do this reconciliation where you look at net income and then you adjust it to basically what if this was a cash business, and then these changes in the balance sheet essentially affect your net cash flows from operating activities, and you summarize the investing and the financing, and then the ending cash balance is basically what you're looking at the end of the year. So again, this statement really shows where the cash has been going, because maybe you were really making a lot of cash from operations, but you're buying so many capital assets that you still need financing. So the question is that the investors might look at it and be like, oh, I see, they need more and more financing because they're investing a lot. And that's really what the cash flow statement shows. And it's also, from an accounting perspective, from a control perspective, it really actually is a good way to make sure that all transactions are reconciling to cash and they're all traceable to an account. And that's an important way to have control over your books, to have basically traceability, is to reconcile everything to cash.